Today on Inspired Money.
You're giving all these billions of people their first computer, their first internet access, and the growth is, I think, unprecedented. I mean, the revenue growth for the sector has been about 38% a year on average for the last decade. And so this is a big growth story. And I think, investors that have any mid to long-term time frame, I think it should be part of their portfolio. I mean, it really is where the growth is in the world today.
This is episode 156 with founder of EMQQ, the Emerging Markets Internet and E-Commerce ETF, Kevin Carter. Welcome to Inspired Money. My name is Andy Wong, a managing partner at Runnymede Capital Management. Each week, we bring you an interesting person to help you get inspired, shift your perspectives on money, and achieve incredible things. From making it to giving it away, Inspired Money means making a difference, creating something bigger than oneself, and maybe, just maybe, making the world a better place. Thank you for joining me. Hey, Inspired Moneymaker, welcome back. If this is your first time joining us, welcome. We're talking with Kevin Carter. He's founder of EMQQ, the Emerging Markets Internet and E-Commerce ETF. His friend and business partner, Burton Malkiel, is an advisor to the EMQQ Index Committee. You might recognize his name as Chief Investment Officer of Wealthfront, longtime professor of economics at Princeton University, and his seminal book, A Random Walk Down Wall Street. As you're going to hear, Kevin always has his eyes open for opportunities. Before starting EMQQ, he was founder and CEO of AlphaShares, an investment firm in partnership with Guggenheim Investments. Previous to that, he was founder and CEO of Active Index Advisors, acquired by Natixis in 2005, and the founder and CEO of eInvesting, acquired by ETRADE in 2000. In this episode, you'll learn different approaches to investing: growth versus value, long versus short, active versus passive. Active, of course, refers to picking stocks, where passive means owning an entire index like the S&P 500. Looking around at your surroundings and thinking like an investor. And then make sure you listen to the end to hear about the opportunity and rationale for investing in emerging markets. Now let's get inspired with Kevin Carter. Kevin, welcome to Inspired Money. It's so great to have you on the show.
Thank you. Great to be here.
Let's jump right in. What's your earliest childhood memory of money?
Well, I think my earliest childhood memory of money was a paper route that I had. But what I remember most about it, I got paid some cash, but I mainly got the woman that was sort of the manager of all the paper boys in my town. I'd go to her house once a month and I could pick out a bunch of candy. And so I got paid partially in cash, but all I really cared about was the candy and the red vines and so forth that I got paid to deliver papers.
That's funny. So you got cash and you got a sweet bonus.
Yeah, exactly. There may not have even been cash involved now that I think about it. Maybe I just got paid in candy.
Whatever you value at the time.
That's right. That's right.
Kevin, I have the impression that you're always reading, you're a lifelong learner. What's the first or foundational book that you've read that got you started down this road of investing?
The first two sort of business books I read were one by Boone Pickens, I think it was just called Boone, and the other one was Donald Trump's The Art of the Deal. The book that I think really has got me where I am now is A Random Walk Down Wall Street by Burton Malkiel, which when I got out of college with an economics degree, and I had one interview with an investment bank here in San Francisco to work in their investment management group. And I had a 20-minute interview, and 19 minutes was a discussion of college basketball. And then I got a 1-minute overview of the investment business, and then was told I could start on Monday. To which I immediately responded, how could I possibly start Monday? I don't know anything. And the guy interviewing me said, well, go buy this book and read it. And he wrote down A Random Walk Down Wall Street. And that book has become a big part of my life.
That's funny. So you studied economics. Did you know what you wanted to do when you got out of school?
No, I did not. I always, and I was a very entrepreneurial kid and had paper routes and all sorts of different sort of jobs that I started selling fruit that was growing in our backyard, door to door, stuff like that. But so I knew I wanted to be in business, and I think that I had sort of two general directions, but without really much consideration as to what either of them meant. But real estate was one. My family, different parts of my family are in different parts of the real estate industry. And then the stock market, and I didn't really spend a lot of time thinking about it. It just so happened that the first interview I got, my uncle, that was quite a large real estate investor in apartment buildings, got me an interview at the investment bank where his then girlfriend worked, and that's where I showed up, and they gave me a job, and then that was my industry, and I feel like it was sort of meant to be, but I can't say I had a lot of planning to be in this business.
What's the other takeaway there, since you had a 20-minute interview and 19 of the minutes were spent talking college basketball? Is it more just connecting with the interviewer?
Well, I think yes. I mean, I think that, for right or wrong, I think having connections is important. And in this particular case, I graduated in December of 1991, and I came into the job, the professional world in January of 1992, and it was a terrible time. I always remember my roommate in San Francisco was a college friend, and he was by far the most trustworthy, responsible, professional type of person I knew. He couldn't find a job. He got a job folding clothes at the Gap, and I, with my 2.0 GPA, got a plum job mainly because of my uncle's relationship within that firm. So I think that was important. And then I think with any interview, obviously you connect with the person that's interviewing you.
What were some of the sort of key things that you learned in that first job?
In my first job, well, it was an awesome place to work, and it was a traditional active mutual fund operation. And what had happened was they had only one mutual fund. It was the Robertson Stephens Emerging Growth Fund, and it had been the number one performing mutual fund in the country in 1991. And then I graduated, as I said, in December of 91. And so it was on the cover of Money magazine in January of 1992. And the phones were ringing off the hook, and they needed people to answer phones and send out prospectuses and so forth. And they hired several of us at once. But so it was just a great way to learn the basics of the investing business. And back then, and even today, there's this, sort of battle between active versus passive. Although in those days, the active camp was considerably larger than the indexing camp. But then within active, the war was between value and growth. And the growth fund was the fund that we had when I started, and that's what, paid me. And that was a strategy of, not caring so much about valuations, but thinking about the future. And so we owned biotech companies, and we owned semiconductor companies, and we owned the earliest mobile phone carriers. So it's a very growth-oriented approach. But about 8 or 9 months into it, they added a value fund. And the growth manager was actually back on the East Coast, but the value manager sat in an office across from mine. And I was sort of an investment gym rat at this point. And so I spent a lot of time with him, and I gravitated towards the value side of things, the let's buy dollars for 50 cents approach and the Warren Buffett approach. But I didn't totally know what it meant. But I could see that there were two different approaches. And then to mix it up even more, the third fund that they launched was a contrarian fund. The investment bank that we worked for was called Robertson Stephens and Company, and was an investment bank focused on technology. All of the Bay Area stuff that was going on at the time, we were the investment bankers for. But the guy whose name was on the door, Paul Stevens, launched a contrarian fund, and he said all this stuff we're underwriting is overvalued. And so I was like, okay, let me get this straight. The growth guy got me, basically, I'm here because of his great performance, at least the year before I got out of college. The value guy makes the most sense to me, but the guy with the biggest office when his name on the door said to buy timber and aluminum and the whole world's going to come to an end. So it it was a fascinating place to start. And I learned that there were lots of people that had strong opinions about ways to do it, to sort of help me form my earliest opinions about mainly the difference between growth and value and how to think about them.
Well, that's one of the beautiful things about investing. There's not just one way to do it. And I am a little bit surprised that Paul Stephens with the Contrarian Fund, it seems to be going against some of the investment banking clients, like what they were doing to serve them, right?
Well, I think these are his private comments to us. I mean, he was really into like mining stocks and just had a very negative outlook on the near term of the world, which turned out to not be accurate. I mean, he had, that particular fund had at one point one of the worst track records, that you always have the top 5 and the bottom 5. And I think he showed up on the bottom 5, for a few periods. And that was in spite of, if I remember the names properly, one of his biggest holdings was a company called Diamond Fields Resources. And it was a Canadian mining operation that was looking for diamonds. And the board of the fund had to have special sessions to decide what to do because they had this, like half of the fund invested in this one stock. And even with that giant winner, I think his contrarian approach was not particularly fruitful.
That is funny. Sometimes it's better to be lucky than good. So you saw a lot in those early years. You also worked at Fastback Brothers for a while? I
worked at Fastback Brothers. Joe Fastback was one of my earlier mentors. The Fastback Brothers had been, from 85 to 90, they were, I think, the number one performing hedge fund in the country, but they were short only. And they fancied themselves as fraud busters and had done a pretty good job of uncovering some fraudulent companies and put together a great track record. And I think in 1990, they had a $500 million fund, and then they doubled it. And that was a big fund back then. And so they came into 1991 with $1 billion. And then, as Joe said, that year, they lost half of the money and the other half people took back. So when my first job was getting created in the 91 sort of NASDAQ rally, the Fastback Brothers were getting crushed. And I joined them in 1995 when they were trying to sort of resurrect themselves as a research shop doing both long and short research. So I worked there, and that was a fascinating time. And really the first time I was given a chance to be an analyst and do my own analysis of different companies.
Being a short seller in short only, that is a very specific skill. What did you learn there?
Well, short selling is the ultimate in value investing. So you've got to be, the fundamentals are important. But I've also learned, and Joe he sort of knew this already, having been through it, but the mathematics of short selling are pretty hard. In the two pieces that are most important are, first of all, the most you can make on a short is 100%, right? So you don't really have the miracle of compounding possibility, right? If you're totally right, you short a company at 15, it goes to 0, you made 100%. And by the way, if you wait till the stock's already at 2 and short it and it goes to 0, you still make 100%. That's kind of limiting because, the real money is made in sort of the miracle of compounding when you're long something and you make 5, 10, 20 times what you invested. So you're capped at 100% gain in a short, which is, again, hard to find those zeros. But the other thing that's very difficult is, if you're long $100 of a stock and it goes down 30%, then you're only long 70 cents, right? So your risk gets smaller. If you're short a stock that you shorted at $100 worth and it goes up, your exposure gets higher, right? And so the mathematics of it are very difficult. And it's also, you see this in the short sellers that are on television. It's just kind of a negative way to live your life, trying to poo-poo other companies and bring them down. So I haven't shorted a stock in a long, long time.
I understand that you had like a personal short position. That was something that taught you a lesson as well.
That was in the spring of 1998, and I had left the Fastback Brothers, and I was out on my own. And I remember I was convinced that Amazon.com was completely overvalued, and it was a just a bookstore, and you could buy Barnes and Noble, a real bookstore, and it sold for a modest PE multiple. And then Amazon.com had this incredibly rich PE multiple. I thought, oh, there's no way that this thing is worth this much. And not only did I short Amazon.com, I told others to do the same thing. I hope no one listened to me. And I lost about a third of my small net worth in a day and a half in 1998. I haven't done this in a long time, but I remember at one point, maybe 8 years ago, looking at what if I had bought Amazon with that money and just held it, and how much would I have? And it made me very sad when I saw the math. And I'm sure if I looked at it today, I might need counseling. But shorting stocks just based on valuation. Now that is a real tough bet. And but you see it over and over again. I mean, Tesla's cost a lot of these people a lot of money. The people betting against Elon.
Yeah, stocks can be overvalued and continue to be overvalued for a long time. The timing is critical, and that can be very difficult. How did that feel for you? I mean, you were a young guy then, but how did that feel, and what were the lessons that you learned?
Well, it felt terrible. I think the lesson was like that's what you said. I mean, well, I guess two things. That your valuation shorts are not a smart thing to do. I don't know that I really realized this immediately then, but I think I'm much more willing now to buy something that doesn't have any earnings, but that I think can be a real game changer longer term, like Tesla, which I bought several years ago. And by the way, the auto industry is also, I think, one of the worst businesses to invest in. But I did. I think the only time I've ever been long in automobile stock is Tesla. So I guess I don't know what I learned. I mean, I'll tell you that what happened. The one most important thing that happened to me that week that Amazon took a bunch of my money from me was that I saw a company called KTEL change its name to KTEL.com. And the stock, which had been $1 a share, went to $30 a share. And I said, oh my goodness, I've read about this. And I went and found my copy of A Random Walk Down Wall Street. And I found the chapter on valuations. And there was a quote in the book, it's still in the book, about the 1960s electronics bubble. And it said, take a company called Shoelaces Incorporated and change the name to Silicon and Electronic Birth Burners. And when the company was called Shoelaces Incorporated, it sold for 8 times earnings. But by adding the word silicon and electronics, the stock goes up, tenfold. And I said, oh my goodness, this just happened. And I need to call this guy. And I used the search engine of the day, Inc.to-me, to find the author of A Random Walk Down Wall Street. And up came his Princeton page with his office hours and phone number. And I picked up the phone and dialed it, and he answered the phone. And I said, gee, the doctor, I thought I was going to get a secretary, but I said, well, gee, Dr. Malkiel, I don't know you, but I read your book. And this is right out of your book, right? You could cross out Shoelaces Incorporated and write in KTEL, and you could take out Silicon and write in .com, and it's exactly what just happened. And anyhow, we had a nice chat, and that was that. But a year later, I picked up the phone and called him again, and he remembered me, and we ended up starting a business together. And now, 20 years later, he's been like my right-hand man for a number of different investment endeavors that I'm proud of.
Have you always had that inclination to pick up the phone? Like you read something in the book and you're like, I'm just going to call the author right now. Or does that stand out as something that was different?
I don't know. I think I was always pretty enterprising about stuff like that. And if I saw something or see something that I think somebody would find of interest, and I don't know that person, but I know of them, I might say, hey, I don't know you, but you will find this of interest. But no, that one, that was a pretty meaningful day in my life. It's interesting. You have these these things that you never know which days of your life are going to end up having the most impact on your life longer term. But that particular couple of days in the spring of '98, it may have cost me some money, but it did lead to my 20-year partnership with this incredible man, Burton Malkiel. So that was the phone call that mattered the most, I think, to the extent I have done other ones.
Coming up, Kevin's wife says he must buy Tesla stock, a first visit to China, and the launch of a leading emerging market exchange-traded fund. All that and more right after this short break. The show notes for this episode can be found at inspiredmoney.fm/156. If you're listening in your car or wherever you are, check the show notes if you want to learn more about Kevin, EMQQ, and all other things mentioned in this episode. It's time for the Runnymede Money Tip of the Week. I want to talk basics today. Have you bought a stock? A few weeks ago, I did a poll on Instagram stories, and a surprising number of you have never bought a stock. Even more have never bought a bond. Many companies offer commission-free trades now. Robinhood is a popular app. Fidelity, Schwab, TD Ameritrade, Vanguard are all great places to start. You can either do it yourself, or you could start with a robo-advisor like Wealthfront or Betterment. Start by deciding what you want to buy. This could depend on how much you have to invest. Let's start with knowing the difference between stocks, stock mutual funds, and exchange-traded funds. The good thing is that stock investing doesn't have to be complicated. For most people, stock market investing means choosing between one of these two investment types. Let's start with individual stocks. If you want to own a specific company, you can buy a single share or a few shares as a way to become a shareholder of that company. Building a diversified portfolio out of many individual stocks, that's possible, but does require more money. The other way to start is to buy a mutual fund or an exchange-traded fund. A mutual fund lets you purchase small pieces of many different stocks in a single transaction. And you're going to need to make a choice. Do you want to invest in a mutual fund that is actively managed by a portfolio manager or a team? Or do you want to invest in a mutual fund that has a passive strategy? There is not a team of portfolio managers picking stocks. It represents an index, for example, the S&P 500. And similarly, if you want to buy an exchange-traded fund or an ETF, it accomplishes many of the same benefits as a mutual fund. It just trades on the stock exchange like a stock, but it allows you to invest in many names, all using just one ticker symbol. So the upside of a mutual fund or an exchange-traded fund is that inherently they're diversified, which lessens your risk. For the vast majority of investors, particularly those who are investing for the first time, a portfolio made mostly of mutual funds or ETFs can be a very good choice. Now, I recommend that you want to be an investor, not a trader. In my career, great traders are hard to come by. Even the greats often have shorter lifespans because trading can be stressful. If you're just getting started, I suggest that you set a plan for what you want to own and then regularly implement that plan so that you're buying the S&P 500, ETFs, or stocks, but just do it patiently and consistently. That's the Runnymede Money Tip of the Week. Inspired Money is brought to you by Runnymede Capital Management. We help you to plan, invest, and worry less. Our Inspired Moneymaker of the Week is Pops Jazz, who wrote this review at Apple Podcasts. Down to earth without being new agey. I love this. Andy provides a sensible, practical approach to thinking about money that is neither snobbish nor too simple. Just the right balance. easy to listen to, and informative. Thank you, Pops Jazz. I also love your username. Inspired Moneymaker, if you're liking today's episode, write a short review or take a screenshot of this episode on your smartphone. Share it on social media and tag me. I'm inspiredmoney.fm on Instagram, Runnymede Cap on Twitter, that's RUNNYMEDECAP, short for Runnymede Capital, or Andy Wong 888 on LinkedIn, that's ANDYWANG 888. Use the hashtag Inspired Money. I look forward to connecting with you. You're listening to Inspired Money. I'm Andy Wong. Yeah, and congrats on your Tesla long that makes up for your Amazon short.
I wish I had held on to all of it that I bought, but that was, I think it was either 6 years ago or 7 years ago, but it was on April 15th. Some year, 5 or 6 years ago, and the stock was at 50 something. And I remember my wife and I had a Chevy Suburban and a Chevy Tahoe, and our town is pretty, we're just over the hills from Berkeley. And I used to say that we have the highest per capita population of Toyota Priuses. And anyhow, I was riding my bike one day and I saw a Tesla on the street, and I stopped and I said, that's a good looking car. What is that? And I went over, I said, oh, that's the Tesla. I said, oh, that's interesting. And I was already looking for some kind of a smaller car that my wife wouldn't get dirty looks in when she went to Whole Foods. And I came home and I pulled up the website and I looked at it. I'm like, oh, this is actually a pretty solid car. It looks like a, nice European sedan. And apparently it's faster and it's the same price or even less than some of the ones I was familiar with. And I remember telling my wife, I said, when you go to Whole Foods, every other car is a Prius, but it's sandwiched between a BMW and a Mercedes. And people buy the Prius because they want to look green or be green. I said, I think this might be the Prius for rich people. And my wife literally pounded her fist on my chest and said, you have to buy that stock. And the next day I did. The timing was lucky because it went up a lot fast, and I had still never even been in one. I'd only seen one, and I think I doubled in the first month, and I said, I got to go down and check this out. And I made an appointment to do a test drive down at the factory. They had this, I think they still have a showroom at the factory in Fremont, and I did a test drive. And I remember when I left the Tesla factory, I said to myself two things. I said, I'm never going to buy a gasoline-powered automobile again. And I said, of every company I know, I'm going to spend more money on this company's products than any other company, and by a lot. As I kind of did the math about myself and my age and my family and number of automobiles required, I was like, I'm going to spend at least a couple $100,000 on this company's products. But I thought, who's at number two? And Apple was and I could think of who do I spend money with, and I thought, well, Apple or Starbucks are probably second and third. But I knew that Tesla was something that was going to be part of my life. And actually, as we're sitting here, we have one Tesla, but my wife's finally going to give up her Suburban, and we got another one on the way. And I'm also trying to get the Tesla roof put on my house here sometime this year. So I'm well on my way to meeting that goal of Tesla products.
Sounds like a very Peter Lynch of Fidelity Magellan Fund approach.
Of all the books that have influenced how I think about investing, I think his approach and lessons were the best, because the value versus growth war was super intense when I was young. And he was the one that said, look, it's both, right? You don't, they're not mutually exclusive. You want things that are growing, that for sure, right? But you also want them to be reasonably valued. And that's why the PE without the G in PEG ratio is meaningless. Like it's impossible to me to make an investment decision based on the PE multiple of something without knowing the growth rate. And so that piece of math was, I think, best articulated by him, also, called growth at a reasonable price, but the PEG ratio, very important. But I think what you were alluding to more importantly was buy what you know. And I think that's incredibly insightful. I always remember that Peter Lynch, I think one of his examples was the legs pantyhose that were sold in 7-Eleven or whatever in little eggs. And his wife had insisted on stopping by to pick some up, and she was raving about them. And that was the way to find stocks, right? And I concur. And when I tell individual investors, I'm like, you are an expert in investing because if you're the customer of the company, then you know how strong their moat is, right? If you know that you're a Starbucks person and you say I don't care if Starbucks is 20 cents more than the other coffee shop, and I'm still going to go to Starbucks, and I'm probably going to go there every day for the rest of my life, then that's an advantage that you have. And so, as Warren Buffett says, you got to stay within your circle of competence. And it's not how big your circle of competence is, it's how well you define the edges. So anyhow, I think Peter Lynch is definitely amongst my strongest influencers. And yes, if I think about this all the time, and I've made investments this way. Pete's Coffee as a stock I made a decent amount of money in. And the one I regret, though, is my wife caught home from Lululemon, which I had never heard of, and I don't think she had either. And she's like, "Oh my God, I found the greatest store ever. It's amazing." And she couldn't stop raving about it. And I think that turned out to be a pretty big stock for some people, but not for me.
Yes, I also never owned Lululemon. And looking back with hindsight, it's one that I wish that I had owned. So, Kevin, at the start, if someone had a crystal ball and told you that you're going to eventually go into business with Burton Malkiel investing in emerging markets, what would you have said back then?
I wouldn't have believed it. Literally, I think the fact that there's multiple bizarre layers to how this went down. I mean, I went to a traditional bookstore to buy his book. And now that bookstore is a Tesla store, literally. And across the street from it is an Amazon bookstore, right? So if you had told me when I picked up the phone and called this guy about this bubble that 20 years later I would actually have a fund that invests in the Amazon.com of China, and the guy that I was about to dial to talk to that day was going to be my business partner, I can't think of anything more bizarre, but that's what's happened.
So let's talk about the emerging market opportunity. And you have talked about sort of the battle between value stock investing and growth stock investing. How is it that you went from active to passive? Because your current fund, let's talk about that. It's a passive ETF, correct?
Yes. So I've had one foot in the world of indexing and one foot in the world of active management for the last 20 years. And I think that's given me an advantage as an investor because I know both sides. Even though I read a random walk, I went to work in the active world, and I was convinced you could beat the market, and I'm still convinced you can beat the market. You just can't own 50 or 100 stocks and expect to do it, and you certainly can't pay someone 1.5% to own 50 or 100 stocks and expect to do it. But in 1996, one afternoon, I was reading the Berkshire Hathaway annual report, and I got to a line from Warren Buffett that said, most investors, both institutional and individual, are better off owning index funds. And my head blew up at that point. I couldn't believe it. I'm like, what? How could that possibly be? My hero on stock picking is saying that everybody should buy an index fund. And I thought, that's craziness. How could he possibly say that? But then I quickly found Bill Sharpe's The Arithmetic of Active Management and realized it was just a simple piece of math. It was, if John Bogle gives it to you for free and all the active guys are going to charge you 1.5%, then there's no way that the average active manager can be better than Vanguard. In fact, that the vast majority have to do worse because of the fees. And so that is, that's an undeniable thing. And so I've accepted that at that point. And then I got mixed up with Burton. And the first thing we did was fact, this was in the papers today. The first thing that I wanted to do that I thought would help save the world, the investors, was fractional share brokerage. So that investors, ultimately what you want to do as an investor is just buy and hold and buy and hold again and buy and hold, just repeat, just save and invest. And the problem was you couldn't do it if you only had $100 or $50. You had to buy a mutual fund. And so we first did a fractional share brokerage called eInvesting that we sold to ETRADE. And then we did a company called Active Index Advisors, which did customizable indexing in a separate account and allowed you to try to beat the index after tax simply by loss harvesting. And that was the second thing Burton and I did together. And that track record's almost 20 years old now and still operated. We sold that company to Natixis in 2004. There was a bunch of early Google engineers heard about that active indexing, and I ended up becoming a sort of default investment advisor to a bunch of Google guys in the end of 2004. And then, and we were doing active indexing, which again was, pre-tax beta, after tax alpha. But the Google guys heard that Burton was focused on China, and one thing led to another, and I got sucked into trying to figure out how we should invest in China, and that, one thing led to another, and then led to EMQQ, which you're right, it's an index fund, so it's passive in that regard. But it's clearly an active bet. I mean, if you go, we own just the internet part of emerging markets. So we don't own the entire broad emerging markets. So anything that's, not the index is active. And so it's an active bet, but it's a passively managed fund.
When was your first visit to China? Tell us about that.
Okay. So my first visit to China would have been in, I guess, 2008, and it was frightening. Burton and I we first went to Australia. Burton was doing Burton's on the Vanguard board, and so we flew to Australia, and he gave a couple talks there, one in Sydney and one in Melbourne, and then we went to Hong Kong. So that was my first time in China at the SAR of Hong Kong. And then after a conference we did there, the Burton went home, and I went to Macau, and then I went to Shanghai by myself, and I didn't know anybody. And I stayed in the Jinmao Tower, which is one of the beautiful buildings across the river from old Shanghai. And it was the most intimidating, few days of my life. I would go out in the streets and cruise around for an hour and a half, and then I would retreat back into the Grand Hyatt and order a pizza. It was not an easy thing, but then I later ended up with a bunch of friends over there that I had a small army of analysts that I hired that were Chinese kids that were getting their MBAs here locally. And so then I started going with them to go travel in China and stay in the cities that they were from and spend time with their families. And so now I'm quite comfortable there, but I was very intimidated the first time.
I visited Shanghai in 1999, and I remember thinking, this city makes New York feel really small and old. Did it blow your mind?
It still blows my mind. I mean, not as much as it used to, but I love bringing people to China because I always tell them, there's no words that can be put. There's no words that you can use to help someone get, quote unquote, get China. In fact, I remember Alibaba has an office here in San Francisco. I remember in our first meeting, the woman that runs it, sort of a corporate relations office, and she'd seen me on Bloomberg TV or something talking about Alibaba's earnings, and the first meeting, I remember she said, "How do we help Americans understand Alibaba? How do we get people to understand that this is a real thing and et cetera?" And I said, "There's only one way. You bring them to China, and you walk around and just let them see it." And it's true. I mean, there's literally no other thing you can do that is as impactful as just bringing someone there and walking around Shanghai for a few hours. And I know there was an investor group that I took to China a few years ago, and they'd never been to China before, and they wanted to know, can we get, how many meetings can we get? And I said, we don't want meetings. Right? You want to just walk around and get on a train and go to a city outside of Shanghai and just see it and walk around it and experience it. And it's still, I'm bummed I'm not going to be there this year, but I'm sure it'll be my first stop after they let me travel again.
And hopefully eat something other than pizza.
Oh no! Now I've got that part set up. I love all the different Chinese cuisines. That's the other thing that people don't appreciate, how many different amazing sub cuisines are within the realm of Chinese food.
So Kevin, the EMQQ, the Emerging Markets Internet and E-commerce ETF, tell us, what is the opportunity for investors?
Well, EMQQ invests in all of the internet companies in the developing world, in China, in India, in Africa, in South America. And so it's Alibaba and things like that. And I think the opportunity is significant. I mean, 85% of the world's people live in emerging markets. 90% of the world's young people live in emerging markets. And then, they're becoming consumers, right? That's the first and most important part of the emerging market story, is the thing that's emerging are the people. As they become consumers, they're also have two other things going on. They're getting their first ever computer in form of a smartphone. And then that is bringing the third thing, which is the internet. And so you're giving all these billions of people their first computer, their first internet access, and the growth is, I think, unprecedented. I mean, the revenue growth for the sector has been about 38% a year on average for the last decade. And so this is a big growth story. And I think, investors that have any mid to long-term time frame, I think it should be part of their portfolio. I mean, it really is where the growth is in the world today.
When we look at ourselves here in the U.S. in a very developed economy, we can see how transformative the internet has been in our lives, how the smartphone changed our lives. And now today, there are things that we take for granted. The emerging market story is just even bigger, right? Because as you said, 85% of the people, there are just more people whose lives are being transformed from a lower base too. So it doesn't take much for like hockey stick growth.
That's exactly it. I mean, it's the same thing that we've lived here in how the internet and the smartphone has changed our lives, but it's times a lot more people and people that have never had a computer before or internet access. So it's the same story, but a much bigger and an earlier inning, if you will.
Kevin, in your view, how much should investors allocate to emerging markets?
Well, what the answer that Burton always gives people when they ask that question is more. That's his answer. And I think that's true. I mean, I think that, and I'm biased, right? This is what I do, and I've become a lot more comfortable with it than most. I think 10 to 15% is sort of an aggressive number in most people's minds, but I think that at least that amount. And I also think that it's important that you recognize that the broad indexes really are not the way to go, and that you got to get a little more targeted with something like EMQQ.
Kevin, I'd like to ask all the Inspired Money guests, how do you define success? In
terms of the thing I care about the most, business-wise, is performance. I mean, that's kind of the beauty of the investment business is you know if you're successful because you've got a track record and a line on a chart, and you see if your line went up or down and how it did versus the other lines. And in that regard, I feel like I've been very successful because the lines that I've created have beaten the other lines. And that's definitely the case with EMQQ. So I define it that way, but I think it's, that's not life. I mean, money is not life and lines aren't life. So I think just loving what you do and loving the people you do it with, that's, I think, how I define success.
Congrats on both fronts. I can see that you have a passion for investing, and EMQQ is having a really strong year this year.
We've had a good year, but more importantly to me, out of all emerging markets ETFs, we do have the number one track record this year. But more importantly, we have it, the best track record of all emerging markets ETFs for the 1 year, 3 year, and 5 year, and since inception. So it worked.
Well, thank you, Kevin. Thanks for sharing your own personal, professional path and story, as well as telling us a little bit about EMQQ. Can you tell the Inspired Money listener where to find out more about EMQQ and what you're up to?
Sure. Well, you can find us at EMQQETF.com. That's where we are. And you can find me on LinkedIn.
Fantastic. Thanks so much. I'll put that all in the show notes and really appreciate it.
Okay. Thank you so much.
So what was your favorite Inspired Money moment? My takeaway this week is to think like an investor. Kevin's stories about discovering Tesla, even shorting Amazon, which was a big mistake. We're always learning, and everything is a process. Investing is no different. Most of the products and services that you use every day, look at them as an investor. If you love a company, maybe you should become a shareholder. Instead of just being a consumer, you can own a part of that company and be rewarded when it does well. Fund manager and author Peter Lynch came up again in this episode. You may recall that One Up on Wall Street by Peter Lynch was the first investment book that my dad gave me. If you haven't read it yet, I highly recommend it. Okay, Inspired Moneymaker, let's connect on social media. Screenshot this episode on your smartphone and post it to social with your favorite Inspired Money moment. Don't forget to tag me. I'm inspiredmoney.fm on Instagram, Runnymede Cap on Twitter, or Andy Wong 888, and that's ANDYWANG 888 on LinkedIn. Use the hashtag InspiredMoney. And don't forget, you can always email me at inspiredmoney.fm/Andy. If you've never bought a stock before and want to, shoot me an email if you need help. I'd love to hear from you and happy to give you a shout out on the podcast. I'll even mail you an Inspired Money sticker or button. Inspired Money is edited by Christopher Wright of Wright Media. Thank you so much for joining me. If you haven't yet subscribed, what are you waiting for? Hit that subscribe button right now so that you don't miss next week's show. I'll see you then. The music you're listening to right now and all other music on today's show is by the amazing Jim Kimo West. Have an inspired week and do something that scares you, because that's where the magic happens.